You won't believe the hidden details we've dug up on Bitcoin ETFs. This is insane. Welcome to another deep dive where we're pulling back the curtain on the top 5 Bitcoin spot ETFs to watch right now. This isn't just about market numbers. It's about empowering your decisions with some really cutting-edge analysis.
And just before we jump in, it's really, really crucial for you to understand this deep dive. It's for educational purposes only. Okay. It is not personalized investment advice. Before making any investment decisions, please, you absolutely should consult a licensed financial advisor. Our analysis combines AI-powered data mining, comprehensive web research, and expert market analysis. And while we believe all this data is accurate as of publication, we assume no liability for errors or any potential investment losses. And remember, past performance does not guarantee future results.
Okay, that's super important. So let's unpack this for you. Our mission today is to cut through all the noise and give you the absolute most important nuggets about these top Bitcoin ETFs. We're going to show you not just what they are, but why some stand out, why certain metrics really matter, and how you can use this info to feel truly well-informed.
Exactly.
You're with ChannelVest, this is your analysis. So how do you even begin to pick the best from like a whole new class of investment vehicles? We're diving into the pretty rigorous methodology that filters through the entire universe of U.S. spot Bitcoin ETFs launched just back in January 2024.
Yeah, and what's fascinating here is the precise screening universe we used. We looked at all 11 U.S. spot Bitcoin ETFs, all of them. And then the hard filters apply. We're talking about an AUM floor, assets under management of $500 million, also a sponsor fee cap at 0.30%.
Okay.
Average daily volume had to be greater than or equal to $50 million shares. And a really tight 2025 YTD tracking error of less than 1% against the CME CFBRRNY.
Right, the BRNY.
Exactly. This is how we narrow down the field.
Okay, and here's where it gets really interesting. The factor weightings. This isn't just a simple list, right?
No.
We're talking a 100-point scale where expense ratio gets 25 points, AUM gets 20, liquidity, that's the 10-day average shares, gets 15%, then net flow trailing 90 days, another 15%, 1 year total return gets 15%, and tracking error gets the last 10%.
And if we connect this to the bigger picture, I mean, these criteria matter because cost, the expense ratio, that's permanent, right? It just eats away at returns. Whereas crypto returns themselves are, well, inherently volatile. And larger funds, just by their nature, they enjoy tighter spreads, better execution, which directly benefits you as an investor.
That makes a lot of sense. All right, stick around because next we reveal the shocking macro trends impacting these digital powerhouses. You won't believe the forces at play. Now let's zoom out a bit to the macro landscape. What economic forces are shaping Bitcoin's journey as digital gold?
Yeah, the key U.S. macro drivers are pretty critical right now. Federal funds futures are currently pricing in about a 54% chance of the first rate cut happening in September 2025.
Okay, so still way off potential.
Still a ways off, yeah. But lower real yields historically tend to boost Bitcoin's digital gold narrative. People look for alternatives.
Right.
And on the inflation front, CPI slipped to 2.6% year over year in June. That's down from 3.1% back in March. So this disinflation trend, it generally supports risk assets.
Good for Bitcoin then.
Generally, yes. Plus, there's a significant development in regulation. A leadership change at the SEC, specifically Paul Atkins, seems to have removed a bit of an overhang from crypto rulemaking.
Interesting. Okay, so what does this all mean for Bitcoin itself? How is it actually behaving?
Well, Bitcoin correlates most significantly with the S&P 500 information technology sector. The correlation coefficient is about 0.42 over a 12-month rolling period.
0.42.
Which basically makes it a tech-adjacent digital asset class and acts a lot like a big tech stock,
Gotcha. But here's the kicker, the one detail that can just erode your returns over time. The cost and yield snapshot.
Oh, absolutely. A mere 26 basis point fee differential. I mean, 0.26%. It sounds tiny, right?
Yeah, it doesn't sound like much.
But it can erode your 5-year alpha by a staggering 1.3 percentage points annually. It just compounds.
Wow. Okay, that's huge.
It is. And what's interesting is EZBC offers the lowest expense ratio at 0.19%. But IBIT, even though it has a standard 0.25% fee, it leads in liquidity by a lot. So this raises a really important question. Is the lowest fee always the best choice? Or does liquidity matter more sometimes?
Something to think about. You're with ChannelVest. This is your analysis.
Sure.
And coming up, we're pitting the top 2 giants against each other. This is insane. Let's dive into the heavyweights, starting with IBIT, the iShares Bitcoin Trust. What's the story here?
Okay, IBIT, launched in January 2024, boasts an AUM of, get this, $87.9 billion.
Whoa.
Yeah, it's the largest pool of Bitcoin among these ETFs. So it really provides that institutional stamp of approval. Its expense ratio is 0.25%, but, and this is crucial, there's a 0.12% waiver on the first $5 billion.
Ah, okay. So effectively cheaper for now.
Effectively cheaper, exactly, for a big chunk of it. It's structured as a grantor trust with Coinbase Prime as its custodian. Pretty standard stuff there. It's seen an 80.21% one-year return. Very strong. And a very low tracking error of just 0.12%. Analyst sentiment, strong. 9 buy ratings, 1 hold.
Sounds pretty bulletproof. Any downsides?
Well, the main bear point to maybe watch is potential capacity constraints if AUM somehow exceeds like $150 billion. But that's more of a hypothetical down the road.
Okay, let's unpack this then. It's the biggest, obviously huge liquidity, but does size always win? How does it stack up against its closest competitor, FBTC?
Right, FBTC. The Fidelity-Wise Origin Bitcoin Funds, the second largest, $24.17 billion in AUM, also a 0.25% expense ratio. Its one-year return's actually slightly higher, 80.39%. Tracking error is 0.15%, also very good.
Okay.
A major bull point for FBTC is Fidelity's established custody infrastructure. That enhances
Ooh.
security, which is, a huge deal for investors. However, it does have a higher effective cost compared to IBIT until that fee waiver expires. And lower liquidity metrics compared to IBIT.
Noticeably lower.
Yeah, noticeably lower, but still very liquid compared to others. It maintains excellent tracking of the underlying Bitcoin price, though, and it's attracted significant institutional inflows, too.
Okay, here's where it gets really interesting. Two titans, similar fees on paper, but one clearly dominates in AUM and liquidity. You won't believe what these differences mean for your portfolio, especially when we look at the next contenders coming up. Moving on from the giants, let's explore the next tier, starting with BITB, the Bitwise Bitcoin ETF.
Okay, BITB. It has an AUM of $4.83 billion and a really attractive expense ratio of 0.20%. It's the lowest among the top 3 we're looking at.
0.20, nice.
Yeah. It boasts an 80.32% one-year return and 0.18% tracking error. Very competitive numbers.
So what's unique about BITB?
What's unique is its commitment to donate 10% of its profits to Bitcoin development. That's a distinct value proposition for some investors.
Interesting angle. Any drawbacks?
Well, it does have lower liquidity compared to IBIT and FBTC, and a wider bid-ask spread, around 9 basis points intraday. So maybe not ideal for super high-frequency traders.
Got it. Next up, ARKB, the ARK21 shares Bitcoin ETF. What's their story?
ARKB holds $5.90 billion in AUM, so a bit bigger than BITB. Expense ratio is 0.21%. Its one-year return is 76.96%, a little lower, and tracking error is 0.20%. ARK's innovation-focused investor base might provide stable long-term holders, and they have a strong research team, obviously.
But, I sense a but.
It has shown higher volatility than top-tier competitors like IBIT and FBTC. And this raises an important question.
Yeah.
It's the only ETF in our top 5 with a sell rating from analysts.
Ooh, okay. That's noteworthy. More skepticism there.
Yeah, indicates a bit more skepticism than its peers. Definitely something to be aware of.
And finally, EasyBC, the Franklin Bitcoin ETF. What's its unique angle? Because we mentioned the fee earlier.
Right. EasyBC stands out with the absolute lowest expense ratio in the entire Bitcoin ETF market, just 0.19%. It has an AUM of $0.62 billion, so the smallest in our group, and a 78.41% one-year return. Franklin's established asset management reputation is definitely a plus.
But there's always a but, isn't there?
There usually is a trade-off, yeah. It suffers from significantly lower liquidity. It has the widest bid-ask spread at 15 basis points, and its smallest AUM limits economies of scale. So while that fee is amazing, the practical trading reality might offset that advantage, especially for active traders.
This is insane. Lower fees aren't always a golden ticket, are they? Stick around, because we're about to unveil the ultimate league table and stress test these funds against market shocks. You won't want to miss this. All right, this is the moment of truth. We've compiled all the key data points into one master league table, giving you a crystal clear snapshot of how these top 5 stack up.
Yeah, you can see it here, ranked by our overall assessment, IBIT, then FBTC, BITB, ARKB, and EasyBC. And for each, we're looking at AUM, expense ratio, one-year return, 10-day volume, tracking error, and the analyst rating. For instance, IBIT just leads the pack, right?
Yeah.
$87.95 billion AUM, almost 60 million shares in 10-day volume. Massive liquidity.
And then EasyBC.
And then EasyBC, yeah. Despite its great 0.19% expense ratio, only 0.1 million shares in volume. Just highlights that huge liquidity difference.
Okay, but here's where it gets really interesting. The risk matrix and scenario analysis. What happens to these ETFs when the market hits a rough patch?
Right. We stress tested them. We looked at three scenarios. A
Right.
hypothetical plus 100 basis point Fed hike, a nasty negative 20% Bitcoin drawdown, and a 2020 style liquidity crunch, like when markets just freeze up.
Okay, what did you find?
Well, all the Bitcoin ETFs show pretty similar price sensitivity to the macro shocks. Like they all drop roughly 11% to 12% with that Fed hike scenario,
Mm.
and almost exactly 20% with the Bitcoin drawdown. That's expected.
Right, they track Bitcoin.
That's exactly. However, liquidity resilience varies significantly. During that liquidity crunch scenario, IBIT spread widens by only 4 basis points.
Only 4? Wow.
Yeah, really stable. Compare that to 6 basis points for FBTC and 9 basis points for BITB.
This is insane. IBIT clearly demonstrates superior spread stability during market stress. That seems like a huge advantage. So what does this all mean for you and the risks to monitor?
Yeah, it's a critical insight. Key risks to monitor generally include regulatory changes, custody security is always huge, and market liquidity. IBIT's sheer scale and liquidity provide the strongest buffer against those liquidity shocks. That's a really critical takeaway for anyone looking at these long-term.
You're with ChannelVest. This is your analysis. You won't believe the actionable takeaways and decision checklists we have for you next. This makes it all so much clearer. We've covered a lot, but now it's time to distill those crucial takeaways and provide you with a decision checklist to really empower your own choices here.
Okay, first takeaway. Spot Bitcoin ETFs are now seriously rivaling gold ETFs like GLD Inflows. That's huge. And IBIT and FBTC. They've captured a massive 74% of the assets already.
Wow, dominance.
Total dominance. Second, fees truly matter. Remember that 26 basis point difference can erode your 5-year alpha by 1.3 percentage points annually. Third, there's a clear liquidity hierarchy. IBIT is way ahead of FBTC. FBTC is significantly more liquid than ARKB and BITB, and those two are much more liquid than EZBC.
Got it. Clear tiers.
Very clear tiers. For most U.S. investors, maybe a 3 ETF core of IBIT, FBTC, and BITB helps balance sponsor risk. Don't put all eggs in one basket. And keep a close eye on SEC custody guidelines, expected Q4 2025, and any headlines about Coinbase's solvency, since they're a big custodian.
Okay, let's unpack this into a practical checklist for you. Whether you're a beginner or a seasoned pro, this is your roadmap.
Exactly. So for beginners, verify you have commission-free brokerage access. Check for auto-reinvest DRI key availability that's important for compounding. And understand the dollar cost average minimums for your platform. We generally recommend sticking with the top 3 for most people. IBIT, FBTC, and BITB. Just balances everything pretty well.
Okay, and for the pros?
For the pros, you might scrutinize factor drift versus the index, look at the premium discount path closely, maybe understand the securities lending split if that matters to you. You might also look into pair trade opportunities like, say, going long BITB versus short GBTC.
Ah, GBTC. Can you quickly explain that? Why that pair trade?
Sure. GBTC is the grayscale Bitcoin trust. It existed before the spot ETFs and converted. Historically, it often traded way off its actual Bitcoin value, big premiums or discounts. A pair trade like long BITB, short GBTC would be a bet on that discount or premium shrinking as the market gets more efficient with these new spot ETFs tracking so closely. It's definitely an advanced strategy, though.
Gotcha. You won't believe how clear this makes the path forward. This deep dive was custom tailored to get you informed fast. So what does this all mean for you as you navigate the exciting, sometimes crazy world of Bitcoin ETFs? The market is evolving fast, right? Staying ahead means understanding not just the top performers, but the mechanics, the risks, the macro stuff. Consider how these factors might influence your strategy. Is liquidity the absolute key for you? Or is squeezing out every last basis point on the expense ratio the main goal? Hopefully, this helps you decide.
We really hope this deep dive has sparked that for you.
Absolutely. Thanks for diving deep with us. Until next time, keep learning, keep growing, and stay well informed.